Okay, look at that sun. Not a cloud in the sky today. Let's see, what do we got? Manchester. Excuse me. Quick question. Still don't get the concept of break-even rates when you explore real rates and its significance. So, you can buy, let's just look at a 10-year nominal U.S. Treasury, a fixed coupon, versus a real 10-year Treasury, a TIPS, with a real coupon. And let's say the difference between them is 230 points, meaning that the break-even, it's implied that there's a break-even rate of 2.3% attributed to inflation, because a nominal minus a real will equal inflation. So if you believe over the next 10 years that the average inflation rate is going to be less than 2.3%, you would take the nominal bond, because the nominal bond would end up giving you more. But if you believe the average rate of inflation over the next 10 years will be greater than 2.3%, you would take the TIPS. That's why it's called the break-even rate, because at 2.3%, you would be indifferent between the two. If inflation is going to run higher, you want the inflation-protected security. Inflation is going to run lower. The inflation-protected security would give you a lower yield than the fixed coupon would. That's why it's called a break-even rate. What else we got on here? Manchester, Sydney, Vancouver, London. Passed L3 a few days back. Job done. Yes, indeed, job done. Study package is a game changer. Glad to hear it. Is performance analyst interesting to you? Performance analyst. I'm going to need a little bit more color behind that. What do you mean by performance analyst? Ireland. Reception bad. I don't know if reception is bad. Let me turn up the volume on my iPad. Here. Let's see what I hear. Reception bad. No. I hear it just fine. Quebec. Saw your market outlook. My short puts are exploding on me. Looks like you're still convicted with TLT play. Yes, I am. Does Iran change your view? No, it does not. Would you roll over your short puts? Not yet. Not this early. Not this far out. No, I wouldn't. I would wait. I'm certainly, rolling over is something I would do when it really appears that I'm not gonna, that it's not gonna recover. I'm really not interested in having the underlying put to me, and I can roll over and pick up yield, pick up premium at the same time. I'm more than happy to have them put to me. So no, I'm not budging from this. Follow up on your point in the video. Is your point that specific inflation cannot be addressed by the Fed? What is the policy to address it? Well, I don't know that that's a solution for monetary policy. It's a solution for fiscal policy. So if the government is really serious about solving the housing crisis, what they would do for home builders is say, if you're going to build 50 spec homes, we will give you a 1% interest loan for 2 years to build these spec homes. That means they would be building 50 homes without buyers, right? Now, if they have to pay 10%, 11% interest, because by the time you buy the land, you can't just throw houses on that land. You have to first develop the land for housing. That could take up to a year and a half to get done. And then you got to start building houses on there. So it could be up to 2 years where you have these loans outstanding. And if you're paying 10, 11%, and usually what happens is that is the It accrues. You don't pay the interest. It simply accrues. And at the end of the 2 year for that development loan, the belief is that as you sell the houses, that's what would pay for the development loan. But that adds to the cost of a house. It adds significantly to the cost of the house if you got to pay that kind of interest over 2 years while you're building it. So it makes it uncompetitive. So if they really wanted to solve it, they would step in and say, okay, well, if you commit to building so many spec homes, we will give you a 1% interest rate loan. Well, then you would have more home builders saying, we'll take that, we'll take you up on that, and you would solve that problem. Higher interest rates isn't going to solve the problem when you have a shortage of housing. It's not going to create supply. The way to solve this problem when you have a shortage is to create supply. So you would have to have policies like that. Yeah. Well, I mean, that's one example for housing. Moldova, Reno, Nevada. Thoughts on the latest CPI print? Well, if you watch the market outlook, I do talk about the CPI print, and it is, I don't think it's a big deal. I think it shows, quite clearly that we do not have general price inflation, which is what, when we say we don't want, when the Fed says, price stability, they mean general price stability, not specific prices. We look at CPI, food's not a problem. Energy is responding to geopolitical issues. Goods, the goods sector, 18%, is in deflation right now. It printed a negative 0.2. Services are at 0.4, but 43% is coming from housing, which is not going to be solved with higher rates. So I've given my opinion in the video. I'd probably direct you to that one. It is par rates and not constant maturity yields. To achieve the par rate, you need a constant maturity yield. So, for example, we can observe a 10-year bond. If it were auctioned today, you could observe what a 10-year bond would yield. That's the yield that clears the auction. It would go out a par bond with that coupon. And that's the par rate. But tomorrow, that's not a 10-year bond anymore. And the next day, it's certainly not a 10-year bond. So a 10-year bond is a 10-year bond for 1 day only. That's 10 years of 365 days a year. The constant maturity extrapolates in and around all the bonds that are around the 10-year mark and says, well, based on where all of these are trading, if we extrapolate where 10% should be, or where the 10-year is today, this is what the yield would be. So they are constant maturity yields, but they are par rates. In other words, they're the rate of what a coupon would be if that bond were sold today at par with exactly 5 years, 7 years, 10 years. That would be the coupon today to create a par bond. That's why it's called the par rate. Performance analysts calculating the performance of funds at the security and portfolio level, conducting attribution analysis on the returns to evaluate the performance against this. Okay, just I get what you're saying there. And what was your question on that one? Is it interesting to me? Not really. No, not really. I'd rather deal with 10Ks than annual performance returns, versus a benchmark. I'd rather deal with 10Ks. No, not really. I was wondering how you would set a discount rate for a certain business segment in a company which is more risky. How would you come up with the appropriate discount rate? So there are two ways to think about this. Is that you could look for a peer that's doing what that business segment is doing and say, okay, well, let's use that cost of capital. Because it is very different than what the company's doing. It might have a different cost of capital. If we think about a sum of the parts, it would have a different cost of capital. But then the other side of the argument is, but that's the advantage of this company doing it, because it can do it at a significantly lower cost of capital than if it were a pure play. So we should value it as part of its capital strength synergy, is that it can extend its capital strength to otherwise risky segments. I guess it depends on how you value the business. If you see synergies between the different divisions, you might say, okay, even though this division is risky, riskier than its core division, there are definite synergies across the two products. Maybe they're complement products, maybe, the existence of the two divisions allows for the sharing of certain resources. Then maybe you would extend the company cost of capital to it. It would depend on the project and what is trying to get done. If it's something that is adjacent, that has, let's say, a target market, it has revenues, it has product development, it's just not profitable yet, I'd be more likely to use the company cost of capital. But if it's a moonshot, if it's, let's say, a company that sells chocolate bars and it's suddenly going to introduce, some kind of consumer electronic equipment, but it's not there yet. There's no revenues. It's just an idea. The idea they have is, maybe it'll work, maybe it won't. They haven't actually gotten to the feasibility stage yet. Maybe it's still in testing. At that point, I would not extend the company cost of capital to it. I would certainly use a more venture capital-like discount rate for it, because it's not guaranteed. It doesn't have cash flows yet. It doesn't have a workable prototype that's ready to go to market, right? So I would then look to value it with a different cost of capital or a different discount rate. Two questions. TLT, in your recent purchase of long duration bonds, why do you think the market has not priced in future cuts? The market is priced in 2 for this year. When you say it hasn't priced in cuts, it's priced in 2. I think you'd have to be more specific. Why isn't the market priced in more cuts? Maybe that's what you're getting at. How come it hasn't priced in more? Why only 2? So I'm not sure how to answer that. I think the market in only pricing in 2 may be just, or maybe acting just as data dependent as the Fed, without taking a step back and saying, okay, well, there's the data today, but there is the longer term effect and the bigger effect of following this course of action that we're on right now. So that's the problem with being mired too close to the data, is you miss the bigger picture. That you could be so focused on cleaning your kitchen, you don't notice the rest of your house is on fire. All right. And I think that when you're too close and you're relying too much on the data today, you miss, I think, what is going on right now is setting the seeds of a bigger problem in the future. So, keeping interest rates where they are right now, when it is clear to me, it seems, that we don't have an inflation problem, we do have a supply problem that is in part driven by high inflation rates, especially in housing. And in other sectors of the economy where we're seeing inflation, we can bring it down to a particular shortage of something. High rates aren't going to solve that. So it seems to me clear that the inflation fight is over. You now have to think about how many lives are you going to destroy? How many businesses are you going to destroy? How much capital are you going to destroy before you start moving? Or are you going to wait for that problem to show up and then run and solve that problem? I think at this point, the risk of causing significant damage, rises every time any of those longer term yields rise. I think central banks are starting to see that. The talk about, inflation being too high and unacceptable is really not showing up that much. You do have central banks that are already signaling when they're going to cut. ECB is pretty much flagging June as when they're going to cut. The Bank of Canada didn't cut, but in the press conference, they were asked, Wall Street Journal just point blank asked, if anybody on the committee was talking about it. And Tiff gave a very cagey answer, which means yes. And, at the very end, he says, you're going to get the deliberations, which are the minutes. The Fed releases minutes, Bank of Canada releases deliberations. Says, you're going to get them in a couple of weeks and you'll see. But he didn't really want to answer it at that point. I think there's pressure. I think they have to do something to move. I think perhaps they didn't want to move at this meeting because you have the federal budget being presented Tuesday night after 4. And I think they thought, well, let's hold off. Liberals are known for major deficit spending that could be inflationary, so let's just wait and see what they're going to do. But if the Liberals can pull it off and convince the Bank of Canada that their spending is not going to be inflationary, then I think the Bank of Canada is pretty much a go for the next meeting. I thought they would go this meeting. I don't know what's holding them back. But by not going, they will hurt more people in the interim. More people will get hurt. So, taking level 3 in August, struggling with the time constraint for constructed response. Well, there is no time constraint for constructed response. There's lots of time to answer them because no answer is more than 20 words. Period. 1 bullet point, 2 bullet points, 3 maximum, and that's only if you don't have the English language and you got to use a whole bunch of small words to make your point. But these are not essays. If you're writing for 15 minutes, you're wrong. For every question you read, 12 marks. 12 minutes should take you 3 to 4 minutes to read all the words on the page. Should take you 4 to 5 minutes to think of your answer. Should take you less than a minute to write it. That's how short the answers are. That's how short they are. So if you are on our site for end of July, beginning of August, there'll be the live drop-in sessions, which are walkthroughs of all the mock exams. And there we go through every structured response question and how to answer different keywords. I was a performance analyst for 1.5 years. Didn't really like it. It was hard and more administrative than investment analyst. You need to be really good with data. Yeah, you do. Is it okay to use incomplete sentences or bullet points? It's not only that it's okay, it's advised. You mentioned you're bullish on Canadian REITs, Canadian residential REITs, not Canadian REITs in general, not all REITs, residential REITs. Yes, I am. But housing shortage is in a number of countries. Why not? Why is market not pricing in future uplift in demand? Why is market not? I'm not understanding what you mean by the market pricing in future uplifted demand. How did you go from REITs? You went from REITs to a bunch of countries to market not pricing in uplift in demand. What does that have to do with REITs? You mean the price of REITs? If you could expand on that a little bit, I'm not sure what you mean there. Let me just pull up a chair here. Hang on. Okay. I just want it to sit instead of stand. Oh, okay, where'd we leave off? Thoughts on Middle East recent news. You mean the unrest and the conflict in the Middle East? Recent news. That news is 70 years old, 69 years old, 68 years old, 67 years old, 66 years old. It's been going on since well before I can remember. So, what's new? I don't know what's new, other than more people waving their fist at each other and threatening each other. What's new? This has been going on since, I don't know. Can anyone remember a time when there was peace in the Middle East? I don't know. Beats me. I don't know. What happened? Iran tried to send some drones into Israel. They got shot down. Iran cheered and claimed victory. Said, yay, okay, we showed them. Thinking, I don't know what you showed them, but, that's a tell. That's a tell. You're not interested in getting into a street fight. I mean, that was pretty obvious. Curious to know if the recent escalation of the conflict changes your investment strategies from the beginning of the year. Nope. No, it does not. I'd like to know your thought process if you are. No, it doesn't change anything. It doesn't change anything because you read a headline and you're just not surprised. You hear something about the region and you're just not surprised. It's like, yeah, wasn't this the headline last week and 3 weeks ago and a month ago and 6 months ago and a year ago and 2 years ago and 4 years ago? And it's not news. It's, what do you want to call it? Throwback Fridays? Hey, here's a headline you might remember: unrest in the Middle East. So I don't know what's going on with the fleas here, but they're not being very friendly tonight. Okay. Just passed level 3. Subscribe to your packages for all 3 levels. Passed each on first try. Wow, excellent, good. Iran launched an attack on Israel yesterday, and not much of an attack. So with so much geopolitical conflict, are we entering a new age of war, Cold War? No, this is the same story it's been for how many years? So what should we throw our money into before we get drafted? No one's getting drafted. No country has any appetite for being, boots on the ground in that region of the world anytime soon. The wars there are unwinnable. They're not 1-year wars. They're decades-long wars. They just never end. I mean, it's. I don't know what solution there is. I really don't know what solution there is, other than maybe no foreign intervention. Maybe U.S. says, you know what? Maybe we're the problem. Maybe we're just not going to pick sides anymore, and maybe things will settle it out, and let the winner be the winner at that point. Typically, you suggest not stepping in front of big risk events like CPI. You said you would sell 93 TLT puts on Monday. I would like to get your thought process on this. I said I would sell 93 puts on Monday if I see downside to it. That if there was significant downside because of Bostic or something that he would say, then I'd be, or I think it was Kashkari, I'd be more than happy to sell puts. And I'm more than happy to keep doing it. I don't see this as a trend. I see this as just a blip. I'm unconcerned about this. So I don't, if you're trading, well, then you got to be concerned about this. I don't mind being in duration for a year. I don't mind it. What else do you think I need to consider turning into bear call spread like this? Bear call spread. Oh, got crushed last week. TLT 100 leaps. Thinking of selling 95 calls. Well, if you have 100 leaps, you got lots of time. You've got lots of time. I don't know why you are too concerned about fixing it right now. You've got leaps. That's why you buy calls with a lot of time. If you think that TLT is just going to go straight down from here, then yeah, maybe you want to sell calls against it. But you bought calls, now you're going to sell 95s. If it starts going up, well, you've got a problem with the solution to your problem. The solution to your problem has just created another problem. Meanwhile, you got a whole year. You got lots of time. Not everything you buy will start earning money the day you buy it. Timing is brutally difficult to do. So you have to ask yourself, is your investment thesis still in play? Is the $100 thesis still in play? And if the answer is yes, then let it work. Let it work. You'll find that if you make trades on a well-informed thought process and you let the trade work out, more than often they work out. Besides, you bought calls. Your downside is limited. The most you can lose is what you paid for your calls. I think it would be too early at this point in time to be selling 95s against it, because that puts you, if it starts to rally, it puts you in a loss position, because you'll lose the spread. So I don't know that I would do that. I don't know that I would do that. I'd give it time to work. Unrelated to the market, but do you play golf? Not really. Not really. I think I've did it for a summer. Didn't really enjoy it. Never really caught on with me. It's like, it just wasn't my thing. I went with, the friends that were going. It was like a summer, and that was it. And I felt no pull, no need to go out and buy clubs and do it again. I felt nothing. So, no. Past level 3, now life can begin. Yeah. Will you be doing anything with ABR around the $12 mark? No, I have 14,500 and some odd shares. I think I'm good with that. Yeah, I've got enough exposure to that. 12 doesn't excite me that much. Maybe around 10, maybe around 9 if it gets there. But 12 doesn't really excite me. Should a country view WAC similar to a company? Not really. Country doesn't have equity. When you say a country, I'm really not sure where you're going with that. Countries have cost of debt. Do you mean a country risk premium if you're investing in another country? Do you mean if a country is undertaking a project? If it is, well, you'd use the country's cost of debt as if the country is financing it. Is gold likely to be a good hedge as the risk of geopolitical risk increases? A couple of things are driving gold right now. Number one is you have declining production. You've had declining production for 4 years now, 2019, 20, 21, 22, 20, well, 5 years now you've had declining production by about 9% over that period of time. You have central banks that are looking specifically to diversify away from the US dollar, and gold seems like a natural thing to hold. You have China, which is loading up. The central banks seem to have been loading up on gold, and you have a population that typically invests their savings in property or in equities, and neither one of those two things are appealing in China right now. So gold is getting incremental demand from what otherwise would have went into housing and equities. And again, it's important to recognize you have dwindling production. Production has been going down about 3,000 tons a year. The forecast this year is, I think, for like 34,000 tons. I don't know. With the rest made up with recycling, the higher the price goes, there's lots of recycling. Keep in mind, there's a huge amount of gold above ground, right? And I think gold, 56% of all the gold goes to jewelry. 13% on average goes to central banks. So jewelry by far is the biggest driver of demand for gold. But the higher the price goes, the more you get recycling, because all that gold still exists. All the gold ever mined exists somewhere. I think gold has its breakout. It has momentum. I think the better correlate right now is the US dollar. If the US dollar weakens, you can see gold strengthen. The thing with geopolitical risk is not a trend, they're events. So you might get a boost in gold because of it, but it's not sustainable unless you have the next geopolitical event, and then the next geopolitical event, and then the escalations of all the geopolitical events, and then the escalations beyond what you thought it would escalate to. You need to keep it going if you're going to keep pushing gold higher and higher and higher. But usually it peaks on an event and then it sells off after, much more stable minds come in and say, wow, it's not going to be everything we thought it was going to be. So you need some kind of ongoing escalation everywhere to have that geopolitical risk continue to allow gold to rally. Thoughts on selling T puts with last week's sell-off? Last week's sell-off is because there is a subsidy for 23 million, I think it's 23 million US households have their high-speed internet subsidized by the government. So they go out and they get a package with AT&T and they receive, AT&T gives them a low price and they get a subsidy. They get the difference from the government. That is ending. I shouldn't say ending. It's like being cut in half, or a little less than half. So the belief is that they're going to lose a whole bunch of these subscribers. I don't think so. I don't think so, because the difference in most cases is something like $15, right? So I just don't think so. So that was the sell-off in AT&T. Was there's a belief that they'd lose a lot of customers because of that. I don't quite believe that. So I sold 17 puts. Do you think CBDC could give central banks more monetary tools? I don't know. I'd have to, I think, read some kind of paper on it as to exactly what features it's going to have, how it's going to be implemented. Is it going to be, what's the phase-in period? What uses are appropriate? I'd have to know a whole bunch about it. Yeah, I'd have to know a whole bunch about it before I could determine whether or not there'd be some policy tools. But I imagine it wouldn't be without something. I just don't know. Would you now consider selling puts on Oxy at its current level, price due to Iran's retaliation and the now elevated risk of escalation? Yeah, I think Oxy is still undervalued at these levels, given its recent acquisition, given its focus on debt reduction. I think they'll put buybacks on the shelf for a while, but I think they'll just be in a healthier position going forward. I don't mind holding Oxy. It's nicer to sell them down around the 57, 50s, and 55s because if they're put to you, oh well, that's great news. If they're put to you at $70, they stayed under $65 for several quarters. You have to be willing to hold it through that period of time, right? If you are willing to hold it during that period of time, well then, yeah, that's good. How would you decide to orient your financial career between research-oriented and quantitative career? Isn't that the same thing? Like when you say research-oriented and quantitative, how is a research-oriented career not quantitative? Can they not be both? Like I'm not seeing the difference in that. How many individual securities do you typically hold in your portfolio at any given time? I don't know. I don't know. I have I have externally managed money that are with fund managers. I think large cap value, large cap growth. I think there's small cap growth and international. I don't know how many securities are in any of those in any of their funds. But for me, if I were doing something, usually no more than 15. It's hard to track more than 15 different positions and be on top of it all and understand how all the correlations work between all those positions. So I think once you get to about 15, your work starts to get incrementally more challenging to stay on top of that. Just found out VIX options are European style. So if you want to trade VIX, do you think it's better to buy a VIX ETF? Well, European just means last day exercise, doesn't mean last day trading. European is any day trading. You can trade European options. It just means it's last day exercise. Well, who cares if it's last day exercise? Who cares? It means, you can, if you're in a profit and you want to take the profit, simply sell the option. Who cares if it's last day exercise? It's better if you're short the options because last day exercise means you're not suddenly going to wake up one day and have an assignment. It can't be assigned to you. It's last day exercise only. That doesn't mean you can't trade it. So who cares? Thinking of coming to Costa Rica. How can I meet you? I'd love to chat with you in person. Well, just let me know when you're going to be around. I'm in the San Jose area, so if you're going to be up north or on the coast, it's quite a distance to get to me. If you're going to be in the San Jose area, then just let me know. Is it okay for a CFA question? Yes, it is. Will you move to YouTube for the live applied series? Maybe it's me, but I've been having a difficulty with Vimeo. Yeah, I kind of think that YouTube might be a better way to go. Vimeo is troublesome sometimes, but I'm probably moving the market outlook over the course of probably the next 6 to 9 months. The market outlook will drift over to the site. which means it'll still be free, but it'll be on the site, which means you set up a free account, you log in, and you'll get the market outlook on the site. And there'll be a comment section there. It's just going to be a better place to put it than having it constantly on YouTube. Yeah, so it will eventually migrate off of YouTube. So I don't know if I would be migrating the applied level onto YouTube, other than or just try to find something other than Vimeo, although it's not that easy. How do you measure investor sentiment for a particular asset class? For example, the demand for gold and silver recently, that doesn't come from traditional sources. Well, that's hard to do. I mean, there's no questionnaire. If I say I want to buy an ounce of gold, there isn't a questionnaire I must answer first of why I'm buying that ounce of gold. So, there could be, a whole bunch of reasons why I'm doing it. So to try to pull it apart is rather hard. But when you hear everyone talking about it, when it's talked about every day, when gold prices are being quoted like stock prices on a daily basis and being talked about, well, there's sentiment. There's some momentum going on there. But I don't know that any one place would be able to give you a percentage saying this is sentiment based, this is central bank based, this is investor based, other than, just broad numbers and say, well, there seems to be something more than just regular demand, but that's hard to measure, and it's hard to measure in real time. Usually you don't get this data till, weeks, sometimes months after. What have your portfolio returns been like? Not great, because I had to leave Canada, and to leave Canada, you have to back out of your investments. You have to transfer them out, and you have to move them to a different country. So there's a period of time, and it's not overnight. It actually takes a lot longer than I would have thought. It's not overnight. So your money is sitting in money market funds for a while until you get this form filled out, you get that done, the accountant gives you a nod to move this much money. You got to do it. There's a process in which it has to be done. So I'd say I probably lost in that whole process a good 3 months. And I'd say there's still a significant amount that's still locked up in a tax return in Canada, that because of the way taxes work in Canada, you have to pay tax on one side to get a tax return on another side when you're shutting down a business. It's just administratively long. So unfortunately, I'm underperforming. I haven't been taking part in most of the rally because I picked this time to move. Or actually, I should say the market picked this time to rally. What is your view on beta as of today? Just not a fan of it. I just can't commit to going long right now. I wouldn't go short. Well, it's not that I can't commit to going long. I got a long-term horizon. So if I bought today, it's just like, oh, well, I don't mind waiting it out. If I'm in good stocks that pay a good dividend and have options and I can work options, then, I don't mind. It's just, why do all that work if you have the risk of downside? I would say that if I had to pick which direction is more likely, actually, let me change that. Which one is more likely? Which direction I believe in more? I'd say the downside. I believe in the downside more than the upside. But which direction is it most likely going to go? Who the hell knows? I mean, this market just seems absolutely willing sometimes to ignore everything and just go higher. No matter what is going on, it just seems that higher is where it wants to go. Well, You know, you don't fight the tape. If that's where it wants to go, that's where it wants to go. But it's hard to get on board. I would have very low conviction on beta right now. Just passed level 3 this Thursday. What comes next, MBA or PhD? Well, I mean, you've got to figure that one out for yourself. But you don't have a master's, it might be challenging for a PhD. Do you think study materials are enough to pass level 1 CFAI study materials? Yeah, they're enough. Are they the most effective thing to rely on? Maybe, maybe not. Depends on you. I know nothing about you, but are they, can you get it done? Sure, they're enough. If ABR at 10 excited you, would you sell $10 puts? I don't know. Depends on the premium. Depends on what got it to $10. Is it $10 justified? Maybe I'd wait to 9. If $10 was unjustified, let's say it had earnings and it had great earnings, great cash flow, and it sold off to 10, I'd say, well, okay, well, this is unjustified. Then yeah, I'd probably just buy it. I don't know that I would sell puts against it. I'll probably just buy it. It depends on what gets it there. Also, do you run your own data sleeve like the one we have in the paper 404? I do, and because it took time to transfer my accounts, and when you transfer it, then you have to have an options agreement. You got to get the options agreement signed. It takes time with larger companies. But yeah, I've started selling puts again. I was in withdrawal. I needed to do it, but I'm back in business again. But yes, I do. Do your real estate sector videos include any methods in comparing REITs? So I don't do a lot of the heavy lifting for you in that respect. What my videos do is you'll get a very good understanding of how to evaluate a REIT. And then it's on you to evaluate whatever REIT you want. I don't know which ones you're going to compare. But at least it explains to you what a timber REIT is, how a timber REIT makes money, and what are the key metrics to look for in a timber REIT. Does the same thing for residential REITs, does the same thing for industrial REITs, you know, what to look for. And then you determine, well, I want to look at these 6. Well, okay, well, here are the 4 or 5 different metrics that you would look at. Go through the 10Ks of the 4 or 5 that you want to look at, open up a spreadsheet, and start, saying, okay, well, NOI growth, what has it been for each one? Debt as a percentage or their debt equity ratio, or their debt service coverage ratio, their payout based on funds from operations, the growth in funds from operations, whatever metrics you want, then you would look at all of them. Now to say which one is better, that's sometimes a difficult question to answer unless I ask you, well, what are you trying to get done? What are you looking for? Are you looking for a great solid source of income? Then you're probably going to look for a REIT that would have a payout ratio somewhere around 80, 85 or 90% of funds from operations. Are you looking for a REIT that retains enough for internal growth and that you're willing to accept a lower dividend yield for a higher growth potential? Well, then you'd be looking for maybe 60% payout on funds from operations. So what are you looking for, right? So you must first tell me what your goal is, what you're trying to get done, and only then can you decide, well, these are the metrics I would look for in what I'm trying to get done. That's way too complicated. I shouldn't say it's too complicated. There are too many possible variations in comparisons to do. So I think it's enough to give you the tools to say, here are the metrics that are important. Now you're ready to look at your company and you look at these metrics. And then you can look at other companies based on these metrics. And you could look at what multiple of FFO they're trading at, what multiple of adjusted funds from operations they're trading at. Where did I leave off here? There we go. Friday, VIX surged by 22%. Yeah, it did. Oil hit 86. Iran just attacked Israel. Iran attempted to attack Israel. It's like saying, you know, you threw a punch at someone as opposed to I punched somebody. I punched somebody means the punch landed. I threw a punch at somebody means, well, I did that. Maybe it didn't land. Iran attempted to attack Israel. What do you think about the market's volatility and the potential inflation from higher oil prices due to this attack, due to this attempted attack? Well, you don't have to ask me. We can just log in to Interactive Brokers and have a look. So let me do that now, because you do have Globex, which is trading right now. So we can see where futures are on Globex. What do we got? Let's look at our watch list. Energy. Energy's flat. Energy's not very exciting at all. Down 2 cents on Brent, up on WTI, up 7 cents on Brent. Not that exciting. Currencies, nothing going on there either. What's the biggest mover on currencies here? The Hungarian forint, no. Norwegian krona is down. Stronger against the U.S. Sweden stronger against the U.S. Hungary stronger. Well, what else have we got? The Mexican peso stronger. Canadian dollar stronger, only 19 basis points, but stronger. The yen, flat, 153.3. We should be keeping our eyes on that thing, eh? Let's have a look at futures. S&P futures in the green. Bitcoin, negative, down 1,100, negative. Let's look at metals. Gold, slightly positive. Copper, big time positive. Whew. Copper's up almost a dime, almost 2.5%. Let's head over to Treasury. ZB, the long bond, negative 0.6, negative 0.6. So a lower open for TLT, a higher open for SPY, higher open for gold, much higher open for copper. The US dollar seems to be and oil seems to be So there's your answer. You don't need my opinion on what's going on there. I think we have our answer. The market is saying, Let's see if we can get a bit more of that glow on the horizon. Look at that beautiful sunset, huh? Isn't that nice? Look at that. Let's see if I can get you a bit more there. There you go. All right, what else we got? Okay to ask a CFA question. I said yes. When selling puts, how do you size your trade? Is it based off expected loss? No, when I sell puts, it's usually because I want to own the underlying, or usually because I'm absolutely comfortable owning the underlying. So I sell puts based on my ability to buy the underlying without margin if it's given to me. Do I have the ability to get it done? Now, I'm not just sitting in cash. I'll be sitting in T-bills at that time. And if it is put to me, I can easily liquidate enough T-bills to get it done. Buying calls on SQQQ. Is there a cheaper and better way to position for a decline on the market? Well, I think buying calls on a short ETF would be probably the same price as buying puts on a long only ETF. Cheaper way of betting on a market decline. Nothing is free. Everything's going to cost you something. If you're going to buy something, everything has a price. So, not really. Well, when you say cheaper, what is cheaper is buying options for a longer period of time than you need, because its decay will be much lower. Its theta will be much lower, which means if you think something is dropping over the next month, buy a 6-month put and then sell it after 5 months. I mean, sell it after a month when it's a 5-month put. Theta will have decayed very little over that period of time. Theta decay is very slow in the beginning. With T well below 17, puts likely to be signed, where would you think would be a good strike to sell calls, or you wait for an upswing? I'm getting paid 6.5% to own it. If it gets put to me, I will sell more $17 puts. And if it rallies and I don't really want to hold the stock, or I have more stock than what I want, if it rallies, which it will, it's a network. It's one of 3 networks. It's one of only 3, and there'll only be 3. It will rally. I'd sell 17 calls if I didn't want to own them, but I would have them. I would let them be put to me. Will you break down the fundamentals on DJT? Well, what fundamentals on DJT? It's run by a criminal who is not interested in building a business, but is interested in extracting the most amount of money he can get from his shareholders. He will fuck his shareholders over in half a second. The idea that you would hold 1 share of his stock is laughable. Anybody who's long at this thing, with Trump owning 60%, deserves to lose every single penny when it invariably happens, and it will happen. It would not surprise me if he's done a box trade on this. Now, that used to be a big thing in the 90s when you had restricted stock. It used to be a big thing in the 90s. Is he going to find a broker to get it done? Well, there's all sorts of crooked criminal people and unethical people everywhere. So it wouldn't surprise me if he's already shorted his own stock in the market, or at least with a broker pledged his restricted stock and had the broker short stock. Would not surprise me. Although the borrow rate is bloody excessive. What is it? 300% a year is the borrow rate. Yeah, it wouldn't surprise me if he did a box trade and then would purposely drive his stock into the ground to make the money on the short side and screw everybody over, because that's who he is. That's who he is. That's who he is, right? So I don't know why anybody would even trust him to even be in business with him. So I don't even think fundamentals. I don't even think there are fundamentals for that company. Is it even going to survive? No. It's just a matter of time before it's a penny stock. It's just a matter of time. I'm assuming you still own the market outlook. I do. So why do you want to move it to the site, which I assume is owned by Serify? Well, I mean, the site is owned by Serify, sure. Moving it to the site gives me better control on the message that I give. The content of the market outlook really is directed towards a CFA audience. It's technical. It does lean more towards that audience. Now, I do get people who are not CFA candidates or CFA charter holders that do watch and enjoy the market outlook, and they do ask some good questions, but I also get some people that watch it that really don't understand it. Not that it bothers me if they ask questions, but it's not really meant for them. That's not the target market. By having it on the site, I can do many more things that I cannot do on YouTube, right? I can have other things on that landing page that I can't have on YouTube. I can do edits to the video that, you know, if I feel that, you know what, there should have been another 2-minute segment right in here. I missed this thing. I can put another 2-minute segment right in without changing the video, right? I could just add it in. I can add in graphics and charts and links on the page right away that I cannot do on YouTube. It gives me a lot more real estate to work with. It also allows me to send out notifications a lot quicker. Now, let's say that I move it to my site and I say, well, you must come to my site, set up a free account. And a free account, really all we need is an email address and a password. That's it. I don't care what your name is. I don't care what city you live in. I don't really want all your information. Just something that you can log in. Now we can send you a notification as soon as it's posted. When I post the Q&A, I can send you a notification. When I do a live Q&A, I can send you a notification that you're going to get. Somebody I know is subscribed to my YouTube channel and says, I'm not getting any of your notifications when you post anything. Well, if you're subscribed, you're supposed to get a notification. Well, you got to rely on YouTube or Google to get that done. Well, maybe they're not getting it done. It just gives me a lot more power to get things done in a way that I want to get them done. I also want to lay it out a little bit differently. This linear process that I have right now, I don't know that it's the best process. I think it would be really great to have a dynamic yield curve on the site, that when you log in and watch the market outlook, rather than having me draw out a yield curve, there is a yield curve right there beside it that you can then click on, and it can show you the evolution of the yield curve from the beginning of the year. And you can see how it's done its bear steepeners and its bull flatteners over time. I can't get that done on YouTube. So I have a lot more power. And yes, Serify owns the site, but I don't think that they're going to be averse to having more interested candidates that are engaged with the content being on their site more. I don't think that's going to bother them. So, yeah. How do we analyze S&P 500 EPS to forecast fair value? Looking at EPS of all 500 companies and applying weighting seems like a lot of work. That's already weighted, by the way. When you have the earnings, those are already weighted, so you don't have to do the work. S&P Global does the work, LSEG does the work. You don't have to do any of the work. That's already done for you. You just have to know what they mean. So it's already done for you. And how do you want to forecast fair value for S&P? Well, what multiple do you think is fair value, right? That's super subjective, by the way. What multiple do you think? Do you think 17 on operating earnings? Maybe 22, 23 on net income? The earnings that we present, that multiple of 20.4, those are operating earnings. There's a lot that happens below the line, so that the multiple of net earnings is significantly higher. So if you're thinking, well, what's the multiple of true earnings, the true earnings attributable to the shareholder, that multiple on the S&P is much higher than 20.5. That's just operating earnings. Fair is the big problem. That's a big word. What is fair? A lot of assumptions go into the word fair. Market expects 2025 expected earnings at 270 at 20. That's a fair value of 5,400. But, well, why stop at 2025? Why not look at 2040 and apply a multiple to that and say, well, I get 16,300. So that fair value, when you're looking at 2025, that fair value is not the fair value today. That is your best guess of what fair value is a year from now, right? If you're looking at 2025, that is fair value as of January 1st. So what you're saying is that we're at 5,100 now. If fair value is 5,400 for December 31st or January 1st, the market really only has 300 points of upside. That's 6% upside, plus 1.5% dividend, you're saying that the market can return 7.5% if in fact those earnings for 2025 don't go down. But I don't know why skip 2024. And you say, for 2025, the further out you go, the more uncertain those earnings are. Hypothetical question: if you had a son, is this going to be one of those surprise? Like, do you remember what's her name from 1996? If you had a son, and given he had an equal interest and competence in finance and technology, what you recommend him to pursue in this day and age, and why? I would not recommend he pursue things. I would recommend he find what makes him happy. What does he enjoy doing? Keeping in mind that there is an economic reality to life. So if he says, well, I want to be a techno punk DJ, it'd be like, son, sit down. Let me tell you about basement apartments and bus passes. We would have a long conversation. If he still felt that that's what he wanted to do, well, then we'd go shopping for a basement apartment and get him a bus pass. There you go, son. You have a good time in your basement apartment with your bus pass. He'll figure out, you got to let people figure out what they want on their own. You can guide them into avoiding certain dumb decisions, but in the end, you have to leave people free to make mistakes, because out of mistakes come the greatest lessons, come the greatest growth. If you have for your whole life made sure that your kids suffered no adversity, no failure, that anything that blocking his way, you stepped in and moved out of the way, you have created a soft person, because the moment that person hits adversity, they're going to fall apart. You do not have a resilient child. You haven't raised somebody who is ready to take on, and let's face it, sometimes the ugliness of the world. Yeah, I think I'd let them do whatever they wanted, whatever they enjoyed. What do you think of that sunset? Isn't that incredible? Are you seeing what I'm seeing? I mean, on my iPad, it looks fantastic. I don't know if you're seeing what I'm seeing, but look at that. That's incredible. We're going to lose it in a few more minutes. I think we got about 5 or 6 more minutes, and it's going to start to get black. So, what have we got now? A couple more questions, and we'll wrap it. Applying your teachings with a theta plane paper trading account, XLE put 36 data expiration 9150 delta 0.19 theta 001, considering the Middle East risk and global need. What do you think? Yeah, I think selling puts on energy right now makes a lot of sense. Hypothetically, if leaving Canada, could you first liquidate portfolio in Canada and buy stable crypto, move to another country, and trade back to old portfolio? Yes, you can. As long as you're, well, you say stable crypto. Isn't that an oxymoron? Stable crypto? It's kind of like, what else is an oxymoron? Intelligent technical analyst? That's an oxymoron. It's funny because it's true. Are you familiar with the Looney Hour podcast? I have listened to it. I don't know that it's something that I would put on my regular cycle. I've listened to it. It's like, okay, well, I guess it's okay. I don't know. Started a leadership position, a family business. Really hard to manage people. Should I be soft or hard on employees? Any advice? In leading people? Well, they have to want to follow you, right? You have to be inspiring, which means you have to set an example. You can't say what you want. You have to demonstrate through your own actions, where the bar is. where you have put the bar so that they can rise to that level. Micromanaging is always a bad thing to do. You have to leave employees free sometimes to make decisions that you wouldn't make. That's the only way they're going to learn. So you can't keep saying, don't do, like if you have to let them free to, to explore. And they'll grow. If they're not growing, well, then there's a bit of a problem. I think with employees, you have to be clear, I think, about the outcome, but not clear about the process. Because everybody does things differently, right? Everybody has a different way of thinking about things and solving the problem. Have some metrics by which you measure some outcomes and some output, and then let them be creative in how they get there. But I would have to know more. When you say managing people is hard, I would have to know more about the type of people that you have. I would not be hard on employees. If you are going to be hard on employees, do not do it publicly. Dear God, don't do it publicly. You bring them aside, you bring them into the office. You never raise your voice, you never attack them, you never attack their personality. You attack the output. You say, look, this output is subpar. It's insufficient. And I think the problem is you're not really invested in this job. I see that you come into the office later than everyone else, you leave earlier than everyone else. I can tell you now that in this profession, that's not the recipe for success, right? So maybe you need to think about where you are and where you want to be. Yeah, I wouldn't be hard on them, but I would set goals and outcomes and hold them to it. And you're not their friend, by the way, okay? You're not their friend. So don't fall into that trap. You're not their friend. You can be friendly, but you're not their friend. Iran attacked 3 military bases. The damage varies, but the cost of Iran's attack is less than 100 million. The cost of Israel's defense is $1 billion plus. The market tonight seems uninterested in it. Nothing I've read suggests that Iran has any desire to continue this. In fact, it seems like they've been calling it a victory, and they had a little bit of a celebration, and I guess their parliament or whatever it's called, they had a little bit of a celebration, and now they're kind of done with it. So I think it's rather dark now. Yeah, you can see that it's dark. The glow is sort of disappearing in the sky. Two more questions, and then we'll call it a night. How's that? I stumbled upon Palantir. Have you heard about it? Curious to know what your opinions are. A couple of weeks ago, I included a segment on Palantir in the market outlook. So just go back, I think 3 weeks, and if you look at the table of contents in the description, you'll see Palantir in one of them. Okay, that is it for the questions. 6:30, that's pretty much when I want to stop. Okay, tomorrow is This Week in CFA, and I'll talk about level 3 a little bit. There's another segment from Richie, something to do with pensions. I haven't looked at it yet. He sent it to me on Saturday. And then Tuesday night is the CFA Q&A. So I'm going to head out. Ciao.